This is a very practical question. I would say retail investors tend to ask, how many percent should I put in robo-advisor? How many percent I should put into unit trust? How many percent I should put in stock? How many percent I should put into ETF in this situation? However, from our professional perspective, this is not the right way to allocate your asset. This is not the proper approach also to determine how many percent you should put into which instrument. The right approach is to look at the total investment that you have got, say for example 1 million. How many asset classes that you want to have access to? Say for example, how many percent go to Malaysia equity? How many percent go to US equity? How many percent go to bond? How many percent go to REITs? And how many percent go to maybe precious metal like gold and silver? So based on these different asset classes that you have got, then for example, Malaysia equity, then only you determine for this particular market, is it better for me to use ETF for Malaysia equity market? Or if I know that there are some unit trust fund can perform better consistently than ETF, then maybe I should consider a unit trust fund in this category. In another sector like US equity, maybe I decide to put 5% into US equity. Then again, I will compare. I invest myself, one option. Go to unit trust, another option. Buy ETF, another option. Then I compare. Then I'll find, oh, for equity in US, ETF seems to be most cost efficient, hassle-free, and good after fee return for this particular asset class. That's where we decide to use ETF in that situation. So that's why do not determine your portfolio diversification by investment instrument. Decide what to diversify in your portfolio by the asset classes that you want to expose into, because it is the asset class that will determine the volatility and the growth of your portfolio, and it's not the instrument. I hope I make this point clear, because I have repeated it a few times, but I guess it is a discipline for a retail investor that may take some time and some further study to fully understand the principle behind of a proper diversified investment portfolio. ETF, the structure is like stock. So if they have got profit and things like that, they would actually distribute dividend. The difference here is that they will declare the dividend, and then you will receive the dividend. And then you can make a decision whether you want to reinvest the dividend into that particular ETF, or you can take the dividend and do whatever you want with the money. If money is important to you, please remember to subscribe to my channel.